Hello, greetings, and welcome to Dividend Blasters. This is our 68th video. My name is Bob, and the topic today is these are my go-to dividend income ETFs. That's right. I'm going to talk about two ETFs that I invest in for dividend income, cash flow. Last video, I talked about my go-to ETFs. One was SCHD, the other one was VOO, which tracks the S&P 500. And the last one was QQQ, which tracks the NASDAQ 100, the tech heavy index. We all know SCHD, that tracks the US Dividend 100 index. So those were the three that I covered. These two today are going to be focused on dividend income, cash flow. And there are trade offs when you buy these, but they are good for me, and I'm going to explain why. First, a disclaimer: I am not your financial advisor. The purpose of this video is for information and education. It reflects my own personal opinions, my research, and my experience as an independent investor for more than 30 years. So please do your own research and consult a financial advisor prior to making any financial investment decisions. One thing I want to mention is that I am profile verified on multiple platforms. So what you hear here on this channel, you're going to see on these platforms where I am profile verified. On X, you'll see the blue check mark next to @DividendBlast99. You'll see it on Instagram @DividendBlasters. You'll see it on Facebook, Dividend Blasters. And you also see me on Threads @Dividend Blasters. Look at the case. Some of them are uppercase, some of them are lowercase. You want to pay close attention to that syntax. My email is drfinance999@gmail.com. And my address for this channel is @dr.finance6447. Why am I telling you this? Well, I periodically see new profiles pop up on some of these other platforms. I see a couple of channels pop up just recently calling themselves Dividend Blasters. That's fine, but I am, my own Dividend Blasters. And I've been on this platform for more than a year. I got over 68 videos now, and I got a lot of material on Facebook and on X and on Instagram. You're free to check them out. So just wanted to mention that. Look for that blue check mark. You'll know it's me. Okay, so let's just talk about, first of all, why do people invest in an ETF? And I've talked a little bit about this on the last channel. And I will just remind you that I'm primarily a stock investor. I invest in dividend stocks, but also invest in growth stocks. I've been doing that for more than 30 years. Last 7, 8 years, been getting into more and more ETFs where I see the benefit of it. So why do I do that? What are the benefits of doing that? Well, first and foremost, diversification. I'm spreading my risk. Now, that doesn't mean I'm going to go ahead and sell all my stocks and say, well, I'm just going to go into ETFs. No, some stocks I have a deep belief in, and I want to have an increased depth of investment and scalability for certain investments that I'm not going to relinquish. Others I'm still looking at, but I do like diversification because it's spreading my risk, and it also allows me to own the market. So you may have heard the saying, timing the market is a fool's errand. I agree with that, especially if you don't know what you're doing. Okay. If you invest in the entire market, you're not timing the market. You're spending time in the market. Time in the market or owning the market is superior than timing the market. Now, if you know what you're doing, and I know what I'm doing, been doing this for a long time, you can do both. And I do both. I own stocks and ETFs. So that's why I do that. I like that broad exposure to a wide variety of assets. I will tell you that I enjoy having that smoothing out of price fluctuations that occur with all investments. And that does occur. It mitigates your risk, it spreads the risk. So that's two. Number three, cost feasibility. ETFs are a wonderful investment if you want to minimize your cost compared to, for instance, a mutual fund. Mutual funds are not always the best instruments to invest in for tax treatment. ETFs are superior to that. I don't own any mutual funds in my taxable account. I have some in my tax deferred account that a money manager manages. That's fine. We'll see how that goes. When I retire, I may just say, hey, listen, let's move these out. I can do that. But anyway, haven't done that yet. So those are the three reasons why I do that. All right. So let's talk about the first of the two dividend income ETFs. The first one, the JP Morgan Equity Premium Income ETF, or JEPI. JEPI is a covered call ETF. You can read the description, but I'll just tell you basically the dividends that you get are coming from two sources. They're coming from the dividends of the stocks that they invest in, but they are also coming from options that they sell. They're selling something called ELNs, or equity linked notes. And these are call options, and these all have exposure to the S&P 500. All of the stocks in JEPI have exposure to the S&P 500. You will see as I go down the list of metrics, they have a high dividend yield. Okay, that doesn't just come from the dividends that these stocks are generating. They also come from the options that these guys are selling. So if you go down half of the page, you'll see dividend yield is 7.30%. You'll notice, if you go back to my last video, none of the other ETFs that I covered have a dividend yield anywhere near that. Okay, if you go back to SCHD, it's around 3.43%. It's a healthy yield and it's a growing yield, but it's about half of JEPI. VOOs, I think it was 1.36%. It's not there for dividends, it's there for broad market exposure. And QQQ, which is there for tech exposure, I believe it was less than 0.6%. So this is a different type of beast, a different type of animal. You're buying this for the high dividend yield, 7.30%. Let's go through the metrics real quick. If you look at the price, they closed last Friday, May 10th, at $57.10. They are getting up near the top of the 52-week range, which went from 51.38 to 57.94. You'll notice that the expense ratio is a little higher here. It's 0.35%. If you were to go back to see SCHD, it was 0.06%. VOO, 0.03%. QQQ, 0.2%. So that's the difference here. This has higher expense ratio because these guys are selling options. They're generating a higher yield. They have to get paid. That costs money. So anyway, wanted to share that with you. So what does that 0.35% mean? That means that basically for every $10,000 you invest in JEPI, you're going to pay $35 a year in administrative fees. What is the price return for the last 5 years? And now they've only been around for 4 years, okay, but approximately 14.35%. So you're not going to get a lot of high price appreciation because there's lots of options selling. That is basically going to take away from the price appreciation of the instrument. The total return is higher. So all these dividends you're getting, and with a higher yield, if you reinvest them, your total return 62.29%. It is still less than the S&P 500, which is over 81%. Now, kind of unfair to compare this because it's still relatively new. We like to look at the near term, okay? But this is the information that I have and that I'm sharing with you. And people right now are buying this for two reasons: the higher yield and the monthly delivery of dividend income, which is fairly high. So look at that dividend yield right now, 7.3%. You'll notice in the graphic that I'm providing that the dividend fluctuates monthly. Right now, the dividend growth rate percentage for the last 3 years is negative, minus 2.79%. That's because it was reduced for a few months last year. Okay. That's not uncommon. That will happen. People don't sweat that for a covered call ETF. They're looking for that high monthly yield. Now, let me just caveat all this. Should you invest everything in a JEPI? I wouldn't. No, no. Um, I like to have a growing dividend in more of my investments. I have more in SCHD. I also have more in QQQ, and I have more in VOO. This has a higher dividend, but it's a little bit more volatile. So I like the cash flow. If they cut the dividend a few months here and there, I do not sweat it. I know it'll go back up, and I like that cash flow. So there's a reason for owning this, and it's different than owning like an SCHD or a VOO. They all have their own purposes. Um, so the dividend growth streak is 0 years. They just reduced it last year. But what you'll see here is the patty, or the projected annual dividend income, is $730 for a $10,000 investment. That is pretty high, and that's an estimate. Remember, these things will fluctuate month to month, but it's not likely they're going to fluctuate like 100%. It might go down a couple percent here and there. So, the smart move is have something in there, but don't put everything in there. One drawback with a covered call ETF is that the dividends you receive are not considered by the IRS. The tax law is, quote, qualified dividends. These are going to be taxed as ordinary dividends. What does that mean? So they're going to be taxed like ordinary income. So, for instance, if you have a capital gains that's taxed at a lower rate, maybe taxed at 15 or 20%, if your ordinary income tax rate when you file your tax return for your job, you could be, if you're in the 30% tax bracket, you're going to pay 30% tax on these dividends. So that's another reason not to put everything here. You're going to have a larger tax obligation. It's good to have some in here, but not everything. It's a strategic move, and that's really what we do with these covered call ETFs. I would say of the covered call ETFs, the JP Morgan ones that I see I like the most, I'm also the most comfortable with. There are a couple others that I have that I'm looking at. I'm going to be doing another video, but that's for another day. What are the top 10 holdings? Train Technologies, you'll see that's about 1.75%. That's a heating, air conditioning, ventilation firm. They do products in that area. Amazon, 1.71%. Interestingly, Amazon does not even offer a dividend. But again, we're not totally dependent on dividends. These guys are selling call options. Progressive, the insurance company, 1.68%. Microsoft, 1.64%. Meta Platforms, 1.54. And Meta, I'll just mention, is very new to the dividend game. They will be paying their first dividend in the next month or so. MasterCard, 1.52%, has a modest dividend of its own, but a very high dividend growth rate. Intuit, the guys that own TurboTax and are a good dividend paying company, they account for 1.52%. Southern Company, the utility, 1.48%. Google Class A shares, 1.48%, and Costco, 1.48%. So that's JEPI. Let's go to the next one. Number two. Number two, JEPI's little brother, JEPQ. JP Morgan NASDAQ Equity Premium Income ETF. I would say what I just said, everything about JEPI applies to JEPQ, except it basically seeks to replicate the NASDAQ 100 instead of the S&P 500 like JEPI does. So it's generating dividends from the stocks that it invests there, as well as the selling of the covered call options. It's a little bit cheaper than JEPI. The price closed last Friday, $53.48. It's getting close to the top of the 52-week range, which has been between 44.67 and 54.47. Expense ratio, same as JEPI, 0.35%. Assets under management, 13 billion. So let me just say this: it's about 1/3 the size of JEPI. It is probably, I don't know, 15% or so SCHD. If SCHD is 50 billion, this is maybe a quarter or less. This is small, but this is very new. This started just in 2022. So they're very new, but they're very popular. Price return for the last 3 years. And again, it's really just, they've been around 2 years, but you're not going to see a lot of price appreciation here, 4.67%, because they're selling a lot of options that's going to pull from it. Total return is much higher, 31%. It's actually beating the S&P 500. Its total return is for the last 3 years, 24.69%. Like JEPI, it's a monthly paying ETF. Dividend yield, it's even higher than JEPI's, 8.92%. We don't have a 3-year dividend growth rate yet. I would say you will not see specifically a very high dividend growth rate. It'll probably be close to what JEPI's is when we get a number. So right now the growth streak is 0, but take a look at the chart. Again, with a covered call ETF, you're going to see a fluctuating dividend rate. It's going to go up and down. Again, you know, I have quite a few shares of JEPI and JEPQ, but I don't have all my ETF investment in these two. I have a smaller amount, but I do it for the cash flow for a couple reasons, because of the fluctuating dividend rate, as well as the tax obligation that I already mentioned. Again, these dividends are going to be taxed as ordinary income, not as qualified income. So the top 10 holdings, Microsoft, and again, this is going to be tech heavier. This is the NASDAQ 100, 7.35%, then Apple, 6.16%, NVIDIA, the wonderful chip maker, and I have shares in all these companies actually, 5.43%, Amazon, 4.91%, Google Class C, 4.8%, Meta Platforms, 4.14%, that other wonderful chip maker, Broadcom, I have several shares of them, 2.97%. Advanced Micro Devices, I would say they're probably the closest competitor to NVIDIA in the GPU game, graphical processing units, 1.85%. Netflix, I want to say, if my eyes are not fooling me, 1.82%. And Tesla, 1.8%. Some of these do not generate dividends of their own, but again, JEPQ is generating its dividends based on the dividends of the companies plus the options that they are selling. So, folks, that is it. Those are the two dividend income ETFs that I invest in, the primary ones for income, JEPI and JEPQ. And before I wrap up, I do want to mention some of the other platforms. I also am on Facebook. I am providing the link there. You'll see the blue check. My name is there, as well as Instagram. You'll look and see the blue check mark next to my name and the profile on Facebook and Instagram that's linked to those, as well as on X. And I'm giving you the address for YouTube as well. I'm providing my email, drfinance999@gmail.com. I also want to share with you just some of my colleagues that are on Facebook and X that I think are wonderful platforms. And I collaborate a lot with several of these colleagues. Dividend Snowball, he is a wonderful discussion group on Facebook. Also offers good content on X. And also Dividends R Us, same thing. A very large group on Facebook as well as on X. Very good content as well. And of course, Saving and Investing for Beginners, and they are on Facebook. So, folks, that is it. Thank you for listening to my video. And if you enjoyed it, give us a thumbs up. Share the video with a friend. Hit that notification bell for notification when the next video comes out, and subscribe to our channel. Have a wonderful day. God bless.